The Great Silver Reset: How Market Manipulation is About to Make Silver an Invaluable Asset. Have you ever wondered if the financial markets are truly free? Or are they a carefully constructed stage where the powerful pull the strings, leaving the average person to navigate the fallout? We stand at a precipice, a moment where the decades-long manipulation of markets, particularly in precious metals and government bonds, is reaching a dramatic and unavoidable breaking point. The curtains are being drawn back on an economic reality that has been deliberately obscured, and the consequences of this revelation will reshape our financial landscape for generations to come. The era of manufactured stability is over. The age of revaluation is upon us. At the heart of this unfolding drama lies the erosion of confidence in the world's once unquestioned safe haven asset, U.S. Treasuries. For years, the global financial system has been built upon the bedrock assumption that U.S. government debt is the ultimate risk-free investment. This belief has allowed for an unprecedented expansion of credit and a seemingly endless ability to finance deficits. However, the weaponization of the dollar, coupled with persistent and ever-increasing inflation, has shattered this illusion. Nations are now actively seeking alternatives, unwilling to have their economic destinies held hostage by the policy decisions of a single country. The numbers paint a stark picture of this declining faith. The U.S. national debt has surged to a staggering $38 trillion as of late October 2025, with an alarming acceleration that saw the last trillion added in just 2 months. This relentless borrowing, now amounting to the issuance of $1 trillion in new debt every 100 days, is a clear signal of a lack of fiscal discipline. As a result, foreign appetite for U.S. Treasuries is waning, a trend that threatens to unravel the very fabric of the bond market. The days of unquestioning demand for U.S. debt are rapidly coming to a close. This seismic shift in sentiment is creating a fascinating and dangerous divergence in the bond market. While central banks can exert a degree of control over short-term interest rates, the long end of the curve is ultimately dictated by the bondholders themselves. And their verdict is becoming increasingly clear. They are no longer willing to accept paltry returns on an asset that is being systematically devalued. We are witnessing a rebellion of the bond buyers, a refusal to fund what they perceive as reckless fiscal and monetary policy. The implications of this rebellion are profound. As demand for long-term treasuries falters, yields will be forced to rise, regardless of the actions of central bankers. This creates a perilous catch-22 for policymakers. Attempts to stimulate the economy by lowering short-term rates are now being met with a sell-off in the long end, effectively tightening financial conditions and negating the intended stimulus. This is not a theoretical exercise. We are seeing this play out in real time, a high-stakes game of chicken between policymakers and the market. The United Kingdom's recent experience serves as a cautionary tale. Despite a series of rate cuts, their 30-year Treasury yields have soared to record highs. This demonstrates the market's ability to override the intentions of central banks when confidence is lost. The bond market is sending an unambiguous message. Fiscal irresponsibility will no longer be tolerated. The era of artificially suppressed interest rates is ending, and the consequences will be felt across every asset class. Against this backdrop of fiscal turmoil, gold and silver are re-emerging as essential pillars of a sound macroeconomic strategy. For too long, these precious metals have been derided as relics of a bygone era, their role as monetary assets dismissed in favor of fiat currencies and complex financial instruments. However, as the flaws in the current system become increasingly apparent, there is a growing recognition that tangible, non-printable assets have a vital role to play in preserving wealth and ensuring financial stability. The current administration appears to be awakening to this reality. The classification of silver as a critical raw material by the U.S. government is a significant development, acknowledging its strategic importance beyond its traditional industrial uses. This move, coupled with a renewed focus on the role of gold in international finance, suggests a potential paradigm shift in how these assets are viewed at the highest levels of power. It is a tacit admission that the current fiat-based system is unsustainable. The surge in the value of precious metals this year is a testament to their enduring appeal in times of uncertainty. Silver, in particular, has had a remarkable run, hitting a new all-time high of over $54 per ounce in October 2025. This represents a gain of approximately 67% year-to-date, far outpacing the returns of both gold and the S&P 500. This outperformance is being driven by a perfect storm of factors: persistent supply deficits, growing investment demand, and an increasing awareness of its critical role in emerging technologies. For the fifth consecutive year, the silver market is projected to be in a supply deficit, with demand outstripping new production. This structural imbalance is being exacerbated by a surge in investment demand, as evidenced by the significant inflows into silver-backed exchange-traded products, ETPs. Holdings in these products have increased by approximately 18% this year, reflecting a growing appetite for silver as a standalone asset class. The industrial demand for silver further underpins its long-term value proposition. Unlike gold, a significant portion of silver's demand comes from its use in a wide range of industrial applications, from solar panels and electric vehicles to electronics and medical devices. This dual nature as both a monetary and industrial metal provides a unique combination of inflation protection and exposure to technological innovation, making it an increasingly attractive asset in a rapidly changing world. The revaluation of gold and silver is not just about their rising prices. It is about a fundamental reassessment of their role in the global financial system. As faith in fiat currencies and government debt continues to erode, the intrinsic value of precious metals becomes ever more apparent. They are the ultimate safe haven assets, a store of value that has endured for millennia, and their importance is only set to grow in the turbulent years ahead. The current economic malaise is having a devastating impact on the aspirations of young people, particularly their ability to own a home. The dream of homeownership, once a cornerstone of the middle-class identity, is now slipping out of reach for an entire generation. This is not just an economic issue, it is a source of profound social and civil unrest. The inability to build equity and establish roots is creating a sense of hopelessness and frustration that is fueling political polarization and social instability. The statistics are deeply concerning. The median American home price has skyrocketed, creating a vast chasm between what the average young couple can afford and the reality of the market. Policymakers are acutely aware of this problem, and there is a desperate push to lower interest rates in an attempt to improve affordability. However, this approach is fundamentally flawed and is likely to exacerbate the very problem it seeks to solve. Lowering interest rates in the current environment is a classic example of treating the symptoms rather than the disease. While it may provide a temporary boost to affordability by reducing monthly mortgage payments, it does nothing to address the underlying issue of inflated asset prices. In fact, it is likely to have the opposite effect, pouring more fuel on the fire of real estate speculation and driving prices even higher. This creates a vicious cycle of ever-increasing debt for young homebuyers, trapping them in a state of financial precarity. The root of the problem lies in the years of artificially suppressed interest rates that followed the 2008 financial crisis. This era of easy money distorted asset prices across the board, from stocks to real estate, creating an everything bubble that is now beginning to burst. The misallocation of resources and the encouragement of excessive risk-taking have left the economy vulnerable and have created a generational divide between those who have benefited from asset inflation and those who are now locked out of the market. The only sustainable solution to the housing affordability crisis is to allow the system to cleanse itself of these distortions. This means raising interest rates to a level that reflects the true cost of capital, even if it means short-term economic pain. Higher rates will temper demand, bring down inflated home prices, and restore a sense of sanity to the market. It is a difficult pill to swallow, but it is the only way to ensure a healthy and sustainable housing market for future generations. The official inflation statistics, as measured by the Consumer Price Index (CPI), are a masterclass in deception. By excluding essential items like food, energy, and housing, the government is able to present a distorted and overly optimistic picture of the true cost of living. The most recent data shows a year-over-year inflation rate of 3%, but this number bears little resemblance to the reality faced by ordinary people. This deliberate manipulation of the data is not just a statistical quirk. It is a form of gaslighting that undermines public trust and prevents a genuine understanding of the economic challenges we face. When the metrics that are supposed to guide policy are so fundamentally flawed, it is no wonder that the proposed solutions are so often misguided. We are living in an era of see no evil, hear no evil economics, where uncomfortable truths are swept under the rug in favor of a comforting but ultimately false narrative. The absurdity of the situation is laid bare when one considers what is excluded from the core CPI calculation. The very things that are most essential to daily life, a roof over one's head, food on the table, and the energy to power our homes and vehicles, are deemed too volatile to be included in the official measure of inflation. This is a clear indication that our value system has been turned completely upside down, where the metrics that matter are ignored in favor of those that can be most easily manipulated. The consequences of this statistical sleight of hand are far-reaching. It allows for the continuation of policies that benefit the wealthy at the expense of the working class. The suppression of interest rates, justified by artificially low inflation numbers, has fueled a massive run-up in stock and real estate prices, enriching those who already own assets while making it impossible for others to get on the ladder. It is a system that is designed to perpetuate inequality and to concentrate wealth in the hands of a select few. To truly understand the state of the economy, we must look beyond the official statistics and focus on the realities of everyday life. The soaring cost of housing, the ever-increasing price of groceries, and the relentless rise in energy bills are the true measures of inflation. Until we are willing to confront these realities head-on, we will be trapped in a cycle of misguided policies and ever-deepening economic and social problems. The Law of 72 is a simple but powerful mathematical principle that illustrates the futility of investing in low-yielding assets in an inflationary environment. By dividing 72 by the interest rate, you can determine how long it will take for your principal to double. When 10-year Treasury bonds were yielding a mere 1 or 2%, it would have taken 36 to 72 years for an investor's money to double. This is a losing proposition in an environment where the real rate of inflation is far higher. This reality has forced investors to seek returns in riskier assets, further fueling the bubbles in the stock and real estate markets. When the risk-free rate of return is negative in real terms, capital will inevitably flow to where it can generate a positive return, regardless of the underlying fundamentals. This has created a dangerous and unstable financial system, where asset prices are detached from reality and are vulnerable to a sudden and dramatic correction. The comparison between the performance of U.S. Treasuries and gold over the past year is a stark illustration of this dynamic. While the 10-year Treasury has offered a nominal return of around 4.5%, the dollar has lost a significant portion of its value. In contrast, gold has surged in value, providing a real return that has far outpaced inflation. This is not a temporary anomaly. It is a reflection of a fundamental shift in the global financial landscape. The big money, the institutional investors who control vast pools of capital, are not blind to this reality. They will not stand idly by and watch their wealth be eroded by inflation and currency debasement. If policymakers continue to pursue a strategy of financial repression, of holding interest rates below the rate of inflation, they will dump treasuries en masse, triggering a crisis in the bond market that will dwarf anything we have seen before. The misguided belief that lowering interest rates will solve the housing affordability crisis is a dangerous fantasy. It is a policy that is doomed to fail, and one that will only serve to indebt a generation of young people further. The logic is simple: when interest rates go down, real estate prices go up. This is because lower borrowing costs increase the number of potential buyers, creating more demand for a limited supply of housing and inevitably driving up prices. The only way to restore balance to the housing market is to raise interest rates. This will have the immediate effect of reducing the number of qualified buyers, thereby tempering demand and putting downward pressure on prices. It will be a painful process, but it is a necessary one. We must be willing to endure a period of adjustment in order to create a more sustainable and equitable housing market for the long term. The current system is a scam, a carefully constructed illusion that benefits the powerful at the expense of the powerless. The fact that property values are not being reassessed downwards in a softening market is a clear indication of this. Local governments are unwilling to lower property taxes, even as the underlying value of the assets is declining. This is a form of institutionalized theft, a way of extracting wealth from homeowners under the guise of public finance. The time for half measures and short-term fixes is over. We are at a crossroads, and the path we choose will determine the economic destiny of generations to come. We can either continue down the road of financial repression, of printing money and inflating asset bubbles, or we can choose the more difficult but ultimately more rewarding path of fiscal responsibility and sound money. The choice is ours, but the consequences of inaction will be severe. The system must be allowed to cleanse itself of the misallocations and distortions that have been created by years of misguided policy. It will be a painful but necessary process, a great reset that will lay the foundation for a more just and prosperous future.